Assalamualaikum warahmatullahi and welcome everyone. In this presentation, we will be talking about impairment of financial assets as per MFRS 9. For this, I would like to give credit to EY for its publications on applying IFRS series specifically for impairment of financial instruments under IFRS 9 2018, KPMG for its publication on first impressions IFRS 9 financial instruments 2014, PwC for its publication on IFRS 9 financial instruments Understanding the Basics 2017, and IFRS Community for its publications on impairment of financial assets IFRS 9 updated May 2020. For this short presentation, I will be touching on how the new model of impairment for financial assets came into being under IFRS 9 and highlight few things on general approach, simplified approach, purchase or originated credit impaired approach, and financial asset and liabilities offsetting. Before we talk about impairment of financial assets, let us look back at the classifications of financial assets. You have discussed these classifications in length in your previous course, therefore I'm going to only touch them briefly. So basically we have three classes of financial assets: amortized cost, fair value through OCI or reserve, and fair value through P&L. For amortized costs, we simply calculate the annual amortizations of its costs at a given rate until its maturity. For fair value through OCI and P&L, we need to assess its fair value at every end of financial year and record the changes, if any, either in fair value reserve and must be shown in other comprehensive income, or show the changes in profit or loss or income statements as part of gain or loss on changes in fair value. So for impairments of these financial assets, where we need to consider any events that may lead to defaults within a 12-month period or its lifetime, which is different from its annual assessments of changes in its fair value, though a significant reduction in fair value may indicate an impairment of the financial asset. While annual assessment of fair value may result in an increase in value, impairment would be always decreasing its value on top of its annual assessment. However, reversal of impairment is also possible. To start our conversation on impairment of financial assets, I want to bring you back to the events that called for the new model, the Great Financial Crisis in 2008. But of course, it started long before 2008. I have shared in Putra Blast some of the videos that you may want to watch to bring you back to that period of financial disaster and help you understand the crisis. For now, just imagine that you have invested all your savings in a portfolio managed by an institution, and the investment was made on financial assets, certificates that promise you a much higher amount in the future, say valued at 100 billion ringgit overall. Now, having such investment and future income, you started to make plans what you are going to do with the money. Perhaps every night before going to bed, you will be planning and calculating. But what if the next morning you got a call from the manager saying that you lost everything that you have invested? There's no money coming in, sealed, not even your principal. All of a sudden, the promises made cannot be fulfilled and you are left with nothing. Now imagine the institution as banks. With such bad investments, just like during the time of the Great Depression in 1930s in the US, people were panicking and withdrawing whatever they have left from their accounts, and all of a sudden banks have no money to recycle. They had to file for bankruptcy, employees had to be made redundant, and the rest is history. In the case of 2008 financial crisis, the financial assets that they were investing in were the mortgage-backed securities, financial instruments that are not backed by real asset, but by the promises of people paying for their housing loans, given in abundance to those people that the banks knew very well will not be able to pay back their loans. Greed blinded their sanity and rationale. But that is how interest works. The longer you delay payment, the greater the amount of interest you need to pay. Thus, banks were the ones causing such a huge, not just financial, but also humanitarian crisis. And that escalated to a global crisis as we are now living in a pretty much borderless economy. As we have learned in earlier FAR courses, an asset depends on its future economic benefits. So long as the benefit exists, we recognize them as assets. And even when we assess for impairment, that is a significant reduction in the asset's value, we will be looking for the indications that tells us, yes, the value will be much lower in the future, based on what has happened. In the events of the crisis, we were not looking forward, but we looked at historical data, and we waited for a significant event to occur before recognizing impairment. Well, by the time the event happened, it is a little too late. Nothing can be saved. This resulted in a huge financial shock. After the start of the economic crisis in 2008, ISB decided to issue IFRS 9 with a particular attention to classification and measurements of financial instruments. The ISB published the final versions of IFRS 9 in July 2014, replacing IAS 39. The main new features include a new model of classification and measurement, impairment, H accounting, and own credit. And the new model of impairment is structured in such a way to avoid the huge financial shock in the future. In short, what we are seeing in the new model is that we are recognizing expected loss rather than incurred loss. And to recognize this expected loss, we do not need to wait for any loss event that trigger impairment to occur. We are forced to analyze even on day one of acquiring the financial assets of any possibilities for expected future loss due to any probable future events that may trigger it. And this is what we term as forward-looking expected loss. The good thing about this is the shock, if any, would be minimized and not abrupt, as we gradually reducing the value of the financial assets by recognizing the expected future loss, or termed as expected credit loss, ECL. If at the end of the instrument period we ended up with a much higher realized value, that would be a pleasant surprise. If the value is lower, we would say we are not surprised. For the ECL, we need to, at minimum, recognize a 12-month expected future loss, that is for a low credit risk. If the risk is not low, we are required to recognize not only 12 months ECL, but a lifetime ECL, that is the lifetime of the financial asset. For impairments of financial assets, please note that the equity is outside of the scope for impairment under MFRS 9, since it can only be classified as fair value through OCI or fair value through P&L without the requirement to recycle changes in fair value to profit or loss when disposed. Please also note that for debts that are classified as fair value through P&L, they are also not in the scope of impairment under MFRS 9. So that leaves us with the financial assets that are not equity and that they are not classified as fair value through P&L. Everything else is included. To assess impairment for financial assets, MFRS 9 introduced 3 approaches to measure and calculate the expected credit losses, each for different types of financial instruments and conditions. We have the general approach. This is meant for all loans and other receivables not allowed under other approaches. The simplified approach. This is meant for trade receivables without significant financing component that requires considerations of time value of money and contract assets under MFRS 15. And the purchase or originated credit impact approach, or better known as credit adjusted approach, where the financial assets are already impaired when acquired. For the general approach, we are given 3 stages, which are actually referring to level of risks or health of the financial assets. What we need to assess is the change in credit risk since initial recognition. If there is a change, we need to assess whether the change is significant or not significant. In stage 1, where the financial assets are known to be performing as stipulated in the contract, this is when increase in credit risk is not significant. For this group of financial assets, whenever we recognize the interest income, we shall base on the gross amount. At the end of the financial year, we are required to assess its 12-month period expected credit loss to calculate the loss allowance. In Stage 2 and Stage 3, both experience significant increase in credit risk since initial recognition, but the increase of risk in Stage 3 will be more significant than the increase in Stage 2. For Stage 2, financial assets in this class will be assessed as underperforming, less than what expected from what's stipulated in the contract. However, for this group of assets, interest income will still be calculated on gross basis. For Stage 3 though, the financial assets will be assessed as not performing, which may mean results being significantly less than what is stipulated in the contract, or we get nothing at all. So for this group of assets, interest income will be calculated based on the net amount, that is after deducting the loss allowance. As for the calculations for impairment loss or loss allowance, financial assets in both Stage 2 and Stage 3 shall be based on their lifetime ECL instead of 12 months ECL. Before we look at how we calculate impairment loss for financial assets as per MFRS 9, let us first look at a few terms used. First, the term credit losses. This is equivalent to the difference between the total amounts of cash flows as stated in the contract and the total amounts of cash flows they are expected to be received given the risks. Credit loss may also arise if you will receive the total amounts of cash flows as stated in the contract, but in a longer period from what's stated in the contract. For example, by contract, we should receive 2 million ringgit in 1 year period, and after a while, we are assured to get the 2 million in full, but instead of within 1 year, we are expected to receive the total amounts within 1.5 years. Now that is an extension of the time period by another 6 months. There is a loss there in terms of time value of money. The second term is expected credit losses or ECL. The word expected there gives us the idea that this is something that we estimate and not absolute but rather a weighted average value. And it is all depends on the probability of default. How sure are we that the default event will occur? 40%, 60% or 100%? Because the event is something expected in the future, therefore there is a need to assess how probable it is to occur and resulted in the expected credit loss. So we could get to the expected credit loss by timing the probability of default with the amounts of credit loss expected. The third term is lifetime expected credit loss. This term simply referring to credit loss that are expected to result from a default within the lifetime of the financial assets. If we talk about debt, for example, that would be from the reporting date to the maturity date. In relation to that, we also have the 12-month expected credit loss, which simply means credit loss that are expected to result from a default within the next 12 months of the financial assets from the current reporting date. The assessment needs to be done at every end of financial year, unless there is a need to do the assessment before the reporting date due to certain events that might suggest a probable, very near future impairment. To calculate the impairment loss, for the general approach, we will more or less follow these steps. First, we need to determine the amounts of contractual cash flows that are due, meaning the amounts stated in the contract. Then we need to determine the amounts of cash flows that are expected to be received given the current condition. Now this can always equal to the amount in the contract if you have nothing to worry about, or it can be less given the situation or risks. Then we determine the cash shortfall, which is simply the difference between the amount stated in the contract and what we expected to receive. And of course, it can always be equivalent to 0. Then we need to discount the cash flows, since we are talking about cash received in the future. And we do this using the effective interest rate, which gives us the amount of credit loss. So the credit loss must be discounted to the present time. Then we estimate the probability of default, which requires some judgments and assessments of information related to the assets and issuers of the assets. And finally, as seen earlier, to get to the expected credit loss, we simply need to times the credit loss with the probability of default. Let us now look at a simple example on how to calculate the ECL. Here we have A Berhad that lent to B Berhad for 5 years. The effective interest being approximately 7.9% at 1 decimal place without any changes over the 5 years, and the loan is measured at amortized cost, thus classified as financial asset at amortized cost. The installment payment is at 25,000 ringgit a year, which amounted to 125,000 ringgit for the entire 5 years. The table of amortization is not shown here. You may do the amortization table yourself if you want, but here we are given the amount exposed at default, or EAD, that is the balance at the beginning of every year of the installment paid and interest taken into account. The abbreviation PD is referring to probability of default. LGD is the loss given default, which means the amounts of loss if B Berhad defaulted, which is equivalent to cash shortfall, that is the amounts that A Berhad will not get back if B Berhad defaulted, and that 80% is from the amount exposed at the beginning of the year. Marginal simply represents a 12-month period or 1 financial year. So the way we calculate the ECL will be EAD times PD times LGD, and then we discount the amount of the number of relevant years. Or, following the previous steps, we can also calculate it by timing EAD with LGD, which is equivalent to cash shortfall, and then discount it over the number of relevant years to get to the present value of the expected loss. For this example, the assessment is made at the beginning of the financial year 2020, assuming the financial year ends every 31st December. So from this example, as at 1st January 2020, the 12 months ECL will be approximately 2,224 ringgit to the nearest ringgit, while the lifetime ECL, which means for the entire durations of the loan, ECL will be at 6,722 to the nearest ringgit. At the end of the first year, 31st December 2020, we assess the credit risk. Is there a significant change in the risk? If none, we simply calculate the 12-month ECL. If yes, we need to calculate the lifetime ECL. So as at 31st December 2020, the 12 months ECL will be approximately 1,845 to the nearest ringgit, and the lifetime ECL will be at approximately 4,858 to the nearest ringgit. Let's look at another example. Here we have VMX Berhad who granted an advance to XR Sec Berhad for 3 years. VMX Berhad did some assessments and came up with this result. On 1st July, the 12 months risk of default is at 2.5%, and for the next 13 to 36 months, the risk default is at 5%. The cash shortfall, if defaulted, will be at 800,000, and this amount is after discounting it. The last column shows the LECL or lifetime ECL at 60,000 ringgit, where the risk of default is at 7.5% given by the 12 months percentage risk plus the percentage risk thereafter. For this example, we want to know how to record the loss provision or loss allowance at initial recognition at the end of the first financial year, that is after 6 months, and at the end of the second financial year. Now let's assume that the risk assessment's results here is valid throughout the year presented here. So at initial recognition, which is also known as day 1 ECL, we need to recognize a 12-month ECL. So we simply times the probability of default, which is the risk of default at 2.5%, with a discounted cash shortfall of 800,000. This gives us 20,000 ringgit. As at 31st December 2021, which is the first reporting date for the financial asset, we need to evaluate whether the risk has significantly changed. We have seen that the total risk of default has changed from 7.5% to 13%, an increase of 5.5%. Because the significance of risk really depends on the reporting entity to judge, one entity may find it as significant, while another may not. If it is considered a significant increase, then we, the entity, shall provide for the lifetime ECL instead of 12 months ECL. Therefore, we simply times the probability of default of 13% with a discounted cash shortfall of 700,000 ringgit, and we ended up with 91,000 ringgit of loss allowance. As at 31st December 2022, the second financial reporting date for the asset, again we evaluate the change in credit risk, and we have seen a decrease of 4.5% from the initial risk at initial recognition. So the change is actually favorable to us. Thus we provide a 12-month ECL instead of lifetime ECL. Therefore, we simply times 1% of probability of default for the next 12 months with the discounted cash shortfall of 500,000 ringgit and end up with 5,000 ringgit of loss allowance. So from that exercise, the journal entries will be as follows. At initial recognition, we will recognize an impairment loss of 20,000 ringgit, an accumulated impairment loss or loss allowance as the standard calls it, of the same amount. And at the end of the first financial year, we recognize additional impairment loss of 71,000 ringgit worth of loss and add that to loss allowance or accumulated impairment loss account. At the end of the second financial year, we recognize a reversal of the impairment or an impairment gain of 86,000 ringgit. Now that the risk of default has reduced, we eliminate the same amounts from loss allowance or accumulated impairment loss account. As at this date, the balance in the loss allowance account or accumulated impairment loss for financial assets account will be at 5,000 ringgit. Now please note, we may have specific impairment loss account for financial assets, which is separated from the accumulated impairment loss account for other assets, or we can always have only one general accumulated impairment loss account, since we will show the details as disclosure anyway. Having discussed how general approach works, I would like to highlight certain things that need some attention. Basically, under general approach, as mentioned earlier, we have something like this. We need to assess whether the financial asset belongs to stage 1, stage 2, or stage 3 of credit risk. We need to decide whether the increase in credit risk year after year is significant enough for the financial asset to be transferred to stage 2 or stage 3. If yes, then we need to recognize not 12 months ECL but lifetime ECL. Now, what the standard does not specify is what significant means. Therefore, entities need to exercise judgment and develop their own criteria, but they have good reason for not specifying how much is considered as significant. In their basis of conclusions or BC document, the standard states that if they specify a fixed percentage change in the risk of default, it will require entities to use the risk of default approach, which not all entities use, and doing it will increase the costs and effort for those entities not using such approach. If they define the amount of change in the risk of default occurring, that would be arbitrary and would depend on the type of products, maturities, and initial credit risks. Instead, the standard emphasized that the determinations of significance of the change in the risk of a default occurring depends on two things. First, the original credit risk at initial recognition. By this, we anticipate that those with a much lower initial credit risk would have a more significant change rather than those with higher initial credit risk. Second, it depends on the expected life or term structure. By this, we expect that the risk of a default occurring for financial instruments with similar credit risk increases the longer the expected life of the financial instruments. Therefore, if the risk of a default occurring for a financial instrument with an expected life of 10 years at initial recognition is the same after 5 years, then this indicates that the credit risk has increased, given the shorter term left. Therefore, we cannot simply compare the absolute risk. Similarly, the standard also cautioned that given a shorter term left to maturity, it does not necessarily mean that the risk of default has decreased. Therefore, entities need to also consider other qualitative factors. You may want to refer to the appendix in the standard, in particular, Appendix B 5.5.17 for a non-exhaustive list of information that may be relevant in assessing changes in credit risk. This is just another way of looking at the 3 stages. Stage 1 refers to low credit risk instruments, while Stage 2 and Stage 3 refers to instruments with credit risk higher than low. In practice, an entity may assume that the credit risk on a financial instrument has not increased significantly since initial recognition if the financial instrument is determined to have low credit risk at the reporting date. You may refer to paragraph 5.5.10 for this provision and Appendix B.5.5.22 to 24 that elaborate on when an asset can be considered to have low credit risk. Another thing that I would like to highlight is the term default. The standard does not define the term default. Instead, it requires an entity to apply a default definition that is consistent with the definition used in its own firm for internal credit risk management purposes for the relevant financial instrument and consider qualitative indicators when appropriate. However, the standard introduces a rebuttable presumption that default does not occur later than when a financial asset is 90 days past due, unless an entity has reasonable and supportable information to demonstrate that a more lagging default criterion is more appropriate. In the end, to apply a general approach of impairment, assessment should be done at each reporting date. It must be based on reasonable and supportable information at the reporting date about not only past events but also current conditions and future economic conditions. It shall be done at individual instruments level or a collection of instruments. An entity shall develop its own policies to determine the significant increase in credit risk. An ECL shall be recognized from the point at which the financial asset is originated or acquired, which refers to day one loss. As mentioned by your colleagues in their presentation, a simplified approach impairment is suitable for non-financial entities because they do not deal with financial instruments on a regular basis, therefore do not require sophisticated credit risk management system. Consequently, it is suitable for financial assets such as trade receivables and contracts with no significant financing components. This simplified approach is also known as loss rate approach. In practice, for such financial assets, we use provision metrics. Basically, what we do is we segment all receivables according to its credit loss pattern. For example, customer type, geographical locations, type of collateral, and so on. Then we set the aging for them, such as those not past due, those past due 1 to 30 days, past due 31 to 60 days, and past due 90 or more days. Then we work on the historical data of these financial assets to calculate the loss rate and this will be the starting point of an estimated loss rate for the future. Historical data may be adjusted to take into account reasonable and supportable information that is available without due cost or effort at the reporting date about the current conditions and forecasts of future economic condition. Thus, perhaps we may also adjust the loss rate. For an example of a provision matrix, let us look at this illustration. This is the historical data of a firm for the month of January for its sales. For this segment, it is assumed that sales are usually made on credit, therefore it has a significant balance of trade receivables outstanding at each reporting date. As there is no significant financing component, it recognizes lifetime ECL for all its trade receivables. In real life, the loss rate should be based on data from several months, but it cannot be too old, as it may yield outdated results. The receivables are presented based on the receivables aging that are not overdue, overdue 1 to 30 days, overdue 31 to 60 days, overdue 61 to 90 days, and overdue 91 days or more, or even not paid at all. And then, based on historical data, adjusted to the current conditions and future economic conditions, we calculate and determine the loss rate. How do we do this? Is by looking at the very end. We have an actual loss of 2,000 ringgit of debt not being paid. Thus, at that point, it is 100% loss, that is 2,000 ringgit over 2,000 ringgit. This 2,000 ringgit is equivalent to 2% of the total initial amounts of debt at 100,000 ringgit, and is equivalent to 4% of the total amount due after 30 days, and is equivalent to 9% of the total amount due after 60 days, and is equivalent to 25% of the total amount due after 90 days. So by analyzing the pattern, we have calculated the loss rate. Basically, we are saying at the very beginning, when the sales were made, we expect a loss of 2%. After 30 days, whatever amount left unpaid, we will be expecting a loss of 4% in the end. After 60 days, whatever amount left unpaid, we will be expecting a loss of 9% in the end. And after 90 days, whatever amount left unpaid, we will be expecting a loss of 25% in the end. Assuming that, taking into account the current conditions and future economic conditions, the loss rate has not changed. We can now apply the loss rate to the current receivables at the reporting date as shown here, and calculate the lifetime ECL by multiplying the loss rate with the amount relevant to the specific aging group, bearing in mind that amount paid and unpaid after certain days are also estimation. For a purchase credit impaired financial asset, this simply means that the financial asset is already impaired at purchase. We may identify such asset with some indicators that can be observed about the asset or the issuer of the asset. Things like, we know the issuer has significant financial difficulties. This may give you some idea that the financial asset that they offered you or offered by another entity is already impaired, meaning we will not be able to get the face value of the asset. Or the issuer breach is contract, either not making payments after the contract is due or even after extended period given. Or we learn that the company will file for bankruptcy or will apply for a restructuring of its debt. Or perhaps the market for the financial asset disappeared, meaning to say there is no demand for the asset, thus it cannot be traded in the market no more. Or we were offered the financial asset at a very highly discounted price, meaning at a very low price. So these are some of the indicators that we may observe to identify a problematic asset or issuers. So for this type of financial asset, we shall not apply general approach. There is no need, since we know for sure that the asset is already impaired. Similarly, we need not recognize day one impairment. What we need to do instead is to include the expected credit loss in the estimated cash flow when calculating its effective interest rate, and this is known as the credit-adjusted EIR. Interest revenue from the financial assets will be calculated using this credit-adjusted EIR based on its net carrying amount, that is, after deducting the initial payment made for the financial asset, and this will be used to calculate the fair value of the asset at initial recognition. Subsequently, we shall recognize a lifetime expected credit loss, not the total lifetime ECL though, but the changes in lifetime expected credit losses since initial recognitions of the asset. If the change is favorable, we will recognize impairment gain, otherwise it will be impairment loss. And in the subsequent years, if we recognize impairment gain after an impairment loss, that will be considered as reversal of the impairment loss previously recognized up to the total amount of the impairment loss, while the excess will be recognized as impairment gain. For offsetting of financial asset and financial liability, there is nothing much to add to the discussion by your colleague, but I simply would like to share what offsetting may means. It can mean that an entity having both financial asset and financial liability in another entity, and it offset the two, and may end up with a net amount that results in either financial asset if it is favorable, or financial liability if it is not favorable. Offsetting can also apply to an entity having multiple accounts in a bank with balances of both debit and credit. Thus, offsetting them will result, again, either in a debit balance where the entity owed the bank, or a credit balance where the entity ended up having positive balance in the bank. Offsetting can also apply in a situation involving three parties, where one of them having financial asset in one entity and financial liability in the other entity, and all three of them agreed to offset the balances. One thing to remember is that it requires written legal contract in order for it to be allowed. Further guideline on offsetting can be found in the appendix of the standard as shown here. So that is all about impairments of financial asset under MFRS 9 that I would like to share. Thank you very much for watching, and I will see you again in the next one, inshallah. Wassalamualaikum warahmatullahi wabarakatuh.